Are you investing in stocks and underperforming the market? Or perhaps you have so many stocks that one 10-bagger would have little or no impact on your overall performance. Well, you need to know it is not enough to choose the right stocks. You also need to know how to combine different stocks in a portfolio to maximize the potential upside and reduce the potential downside. The objective of diversifying is to reduce risk, but on countless occasions it ends up being what is known as diversification, or what is the same, increasing the number of companies in the portfolio causing a worse return. How many stocks you should have in your portfolio to achieve success in your investment is a question that has plagued investors for ages. Thankfully, Warren Buffett has us covered on this topic, and he thinks not many investors are doing it right. In his own words, he said,
"We think that diversification, as it is generally conducted, makes very little sense to anyone who knows what they are doing."
So at a glance, we can see he actually liked to focus on as few stocks as possible. In the first investment in stocks he made back in 1941, at 11 years old, he bought 3 preferred shares of a company called City Service for a total of $115, which was pretty much his entire net worth at the time, so not much diversification to speak of. A few years later, when Buffett was 19, when he first got in contact with Benjamin Graham at Columbia Business School and read Ben's book, The Intelligent Investor, his mind changed a bit. Graham operated an investment partnership called Graham Newman, and in 1951 this partnership had over 100 different positions in its portfolio, which was quite a contrast to Buffett's philosophy at the time. But in his defense, we have to mention it was concentrated in the stocks with the most upside potential. For this reason, Buffett thought that perhaps it was a good idea to diversify his portfolio a bit and bought 6 other stocks. And like Graham, he decided to invest heavily in his top pick. You will find opportunities where, if you invest less than 10% of your wealth in them, you have wasted a huge opportunity because you have not really invested as much as possible. In January 1962, Buffett became a millionaire through his own investment partnership, known as Buffett Partnership Limited. If you want to learn more on this, I recommend you the book Warren Buffett's Ground Rules, which you'll find in the description. Very little is known officially about the partnership's positions, but Buffett has hinted a few times at how his investments were distributed. In 1962, he stated that he usually has fairly large positions, 5% to 10% of the total assets, and 5 or 6 generals, which was what Buffett called one type of investment in the partnership, with smaller positions in 10 or 15 others. And in 1966, he said he had only 5 or 6 situations in the 9-year history of the partnership where they had exceeded 25%. With this, we can still say that Buffett initially liked to avoid too much diversification and focus on the best opportunities. However, if we fast forward to today, we would not get the same idea. Warren Buffett owns more than 40 publicly traded companies and more than 50 wholly owned subsidiaries. But don't panic yet, there's a reason behind it. Buffett would love to operate a concentrated portfolio if he had the chance, but given the current volume of assets under management, he can no longer do so and is forced to diversify more than he would like. But that doesn't mean he thinks diversification is necessarily a good idea for individual investors with a more limited budget. But you and I don't need to limit ourselves to large companies, so let's see the 4 rules Warren Buffett would use to determine how diversified your portfolio should look like. The first thing you should keep in mind is the following. To begin with, are you an experienced investor? Warren Buffett once said,
"Diversification is a defense against ignorance."
That is, you should buy everything if you are afraid of permanent loss of capital due to poor decisions. There is nothing improper about that. It's a completely suitable strategy for someone who is unfamiliar with business analysis. Owning 50 shares, let alone 40 or 30, is insane if one understands how to evaluate firms. Not every company on the market is a sure thing, and it's conceivable to make a few consecutively bad bets. An experienced investor at least has a general concept what he's betting on when investing. It is best to diversify your investments if you are unsure of what you are investing in and have not thoroughly researched the firms you wish to invest in order to prevent lasting financial losses due to serious investment errors. The best course of action in this situation would be to make an investment in an ETF or an index, such as the SP 500. A serious investor should do at least the following before investing in a company. Thoroughly examine the financial statements of the companies in which it invests. Investigate the management and owners of the companies. Understanding who are the main competitors in the sectors in which it invests, and compare the price, whether it is cheap or not, of your investments with other opportunities in the stock market. Since this exercise entails a significant time commitment, index funds are the best option for people who cannot devote much time to stock analysis. As Buffett said in 1993, by investing periodically in an index fund, the know-nothing investor can do better than most investment professionals. Secondly, do you invest in risky stocks? Some diversification is important, even at casinos where the house has a quantifiable edge. There is a cap on the amount you can bet as a result. Casinos are aware that a losing streak can make them bankrupt and that no amount of outstanding past performance will compensate for it. You need greater diversification the riskier the bets you place. With us, risk might refer to a number of different things. One is the risk of permanent loss of capital, and the other risk is simply a mediocre return on the capital we invest. Obviously, the stock market is not as quantifiable as the casino. In terms of risk, what you have to watch out for are the stocks where, if you make a mistake, you are likely to lose everything invested. Here are some of these situations: startups, bankruptcy cases, highly changeable sectors, and virtually anything involving leverage. Third, you must assess which opportunities seem better. It seems irrational to have an outstanding investment opportunity identified and invest in stocks that are 20 or 30 on your list of appealing stocks at the cost of not investing more in stock number one. If you are a knowledgeable investor, you should be able to assess the attractiveness of specific opportunities, if not globally, then at least within your area of expertise. For instance, let's say you've discovered businesses that, in your opinion, can provide the following returns. It would be logical to stock up on your top 5 ideas in this situation. Your predicted returns will be lower and you will be worsening performance if you add an equal portion from business number 6 to company number 10 to your portfolio. You should also spend far more money on your best pick than on the others. Similar to what Buffett has done with Apple recently. Finally, think about whether you can recover from the loss. You will come across situations where it would be a mistake to not have half of your equity invested, especially if you are working with lesser budget. The fourth rule is that you need less diversification if you have less capital. It depends on where you are in your investing career and how much you earn. If you just had 1 month's payslip to invest, for instance, you can go wild and stake the entire sum on one stock. It wouldn't even matter if you stated you'd bet the entire sum on roulette, but at least you'll receive your money back the following month. However, you should start considering diversification when we start talking about amounts of money that will take you several years to recover with your 9-to-5 job. To sum up, as we have discussed, you should concentrate your portfolio more if you are an investor who knows what you are doing. You are buying assets that have a low risk of adverse outcomes. You expect a large return spread between the opportunities you have found, and you can replenish your capital fairly quickly through income. As you may have guessed, this is not an exact science. But an investor will have a distinct advantage when he is aware of which way his thought process is going. With this, we say goodbye to the video. I hope this video has been helpful. If you liked it, leave your like and subscribe, and don't forget to leave your questions and opinions in the comments.